So standard disclosure language. Today I want to talk about the markets, global trade, and tariffs, which are the centerpiece of former President Trump's economic platform. But before I start, I want to just start by thanking Rob Garrett for his help with last week's discussion on China. Rob did an amazing job sharing his perspectives on 5 scenarios for the future of China. And
you mean Francis Basolino?
Oh, yeah, I'm sorry. I'm Francis, yes. And Francis will be joining us again to do this going forward. So much appreciated. So China announced their stimulus, additional stimulus, and the market seemed to be of two minds. Some traders are very bullish and some investors are more suspect about the long term. I believe it's a bit of a disappointment for the markets in that it appears that President Xi and the party are really focused on stabilizing the economy, not stimulating. Two very different outcomes for the global economy and for different parts of the market. I also think that they're really focused on the long game, and will it be enough is the big question. I think that's going to depend on how much growth they can get with these policies. Geopolitical considerations, can they reverse the capital flow problem, restore confidence, and rebalance the economy? We also talked about Europe lately, and Germany, France, and the UK are all dealing with economic stresses. The numbers are not particularly strong out of any of those areas. And Mario Draghi's proposal to implement some reforms to help with European competitiveness are confronting really economic, political, and social realities, which will make it unlikely that some of the needed reforms get put through. So I think Europe's going to continue to struggle with pockets of opportunity in the venture area. And here at home, I think the election's sucking the air out of every room as the policies of both candidates are getting more expensive by the day. And I think it's too close to call, so we're going to go down to the wire. And Mark, on November 7th, we may be weeks away from knowing the final outcome, unfortunately, given the way I think some of the voting is going to go and getting the results done. Yeah. So that kind of brings us to where we are today, and I want to talk about what's going on in the markets and trade and tariffs, so jump right into it. With all the problems in the world, the market continues to hit new highs. The S&P from its low October in 2 years ago is up over 62%. And the estimates now are looking at 250 on earnings for this year, maybe 275 next year, and 300 the year after, which with 20 multiples would give you, 580 on the 5,800 on the S&P. 6,300 next year and 6,800 the year after, which is interesting. What makes this more fascinating to me is this is happening while rates are moving up, not down. And the yellow line is rates a year ago, so we are down from a year ago, but the red line was 1 month ago, blue is 1 week ago, and the green is where we are as of last Friday. So you can see that we've had a move back up in rates, and over a month, we've moved up about 45 basis points. The other fascinating thing is the market's hitting new highs and money market balances are on the way up at almost $6.4 trillion. And one of the concerns that I've mentioned in the past meetings is if the Fed cuts too aggressively, they could create a bubble. And if they continue to go down the path of 50 basis point cuts, which they're backing off from, and that's what the market was expecting, that you would see this market ripping. And I think that would be good in the short term and terrible over the intermediate term. I think the Fed is starting to back off from the expectations they're going to be as aggressive on cutting rates. They're starting to talk about 25 or a pause. I think this is important, but if they get too aggressive on rate cuts, you could see this market melt up. And that would not necessarily be a good thing over the longer term. So really interesting dynamics that we're seeing. So the Fed's under a lot of pressure right now because since their 50 basis point cut, the jobs number came in much stronger than they were expecting. Inflation is still trending towards target, but not quite as quick as everyone thinks we're going to get there. So that would suggest that maybe the Fed's 50 basis point cut last month was too aggressive. So we think this is a time to really think that the Fed's not going to move as much as they think. The ECB is going to move some. China is looking at what they're going to do in stimulus more on the fiscal side. And then the rest of the world is kind of being left to see how the major economies move right now before they react. So I think there's a lot going on here, but the setup is still strong for the US markets and the US economy. I think the world economy has some pressures on it that will be with us for some time, but let's jump to look at trade and how it's evolved. And this is an interesting chart from our World in Data. It's really from the UN and the Peterson Institute. And if you think back to 1870, we went through this industrialization period with new technologies coming out, which led us into the World War I and the post-World War II period, World War I period, leading up to World War II, which feels a lot like some of the characteristics we're experiencing today with difficult debt loads, bad policies, some bubbles that you've seen work out of the markets and the like. And this is a time that what we're seeing today in this globalization is a period that Ray Dalio's referenced back to the 30s on more than one occasion as some of his concerns about the geopolitical and domestic politics and debt problems of the world. But then coming out of World War II, we had this massive rebound as we had to rebuild all over the world and put people back to work and move from a war society to an industrial society. And that led to the success we had for most of that period. A lot of this was governed by the post-World War II period institutions that are now under pressure. And then we had this period where the liberalization and globalization took off in the 80s, which led to this big boom that we're now dealing with now. And how do we deal with China and everything coming into being and becoming major players in the system? That's what's changed in the world. And we're facing this globalization period now where we have to figure out with the debt and geopolitical problems and domestic problems and climate problems and population problems, how do we move forward? So I think we're at a very interesting time for how world trade is going, but trade continues to rise, and it is 50% of GDP and 25% of US GDP. But if you look at this dark red line here, you can see that trade is continuing to move up from the 70s forward on a global basis, and for the US pretty much moved up until we hit the great financial crisis, and now we're back on an uptrend. But you can see for many of the developed nations, the last couple of years have been very tough, and we're now seeing a slowdown in trade and a slowdown in trade as a percent of GDP for them, which is not good, particularly for China, which is one of the world's manufacturers. And I would say the chart for China is starting to look in a similar fashion. The U.S. has been a big beneficiary of foreign direct investment flows, which have changed because of the pandemic conflicts and policies. But you're starting to see flows even to the U.S. slow in the last period. So I think you're going to see fits and starts in foreign direct investment flows around the world, stemming from the industrial policies and also the interest rate structures and dollar currency structures around the world. So what's changed in trade? And I think it started with Trump. And he changed the mindset both domestically and globally about tariffs and how we should think about global trade. Then you had the pandemic, which shifted the supply chain issues and rethinking from lowest cost to most reliable and secure. Then you had the Russian invasion, which led to national security issues and rethinking of that and a realignment of sourcing of critical needed resources, which then bled into the new industrial and military policies that we talk about a lot in the 361 community. And then you also have to throw in the frustrations with workers and their governments and the policies and what that meant when we had the carve out that went on. And I think these are all factors that are playing in. But what's really fascinating is Trump is now talking about tariffs as a way to rebalance the U.S. economy and do it by lowering taxes and everyone else will pay for it. But what's really interesting to note is that post-World War II boom that we saw started with US lowering tariff rates are all over, and not just the US doing it, but then you look at the BRIC nations lowering their tariff rates when they entered the WTO and how that led to the boom over there. And to think that raising tariffs is going to be a good thing, I struggle with Trump's policies. I also struggle with Harris's policies because I think they're ideologic and not based in sound economics. And I think free trade is a big part of it. So I think the globalization process will continue. I think we're going to see these fits and starts around trade and the idea of, will tariffs help and do what's being described? I don't think that's the case, but I would caution you that tariffs are something the president can do without much input from others. And I think that's important too. He doesn't need Congress to do tariffs on China. If he did the across the board 10% tariffs, that may be more problematic. So he's proposed 60% tariffs on Chinese imports and 10% across the board. He can do the China ones on some grounds. I think the across the board may need Congress, which would require him to have a sweep, which I'm not sure is likely, although the odds are pretty high for that. Around 40% is what the betting markets are at. Tariffs were originally about unfair trade. Now it's about reducing dependence on China. And this is where China is saying it's really about containment. And I think this is where the US policy can backfire on us in terms of our global positioning. But I think China can respond and can respond pretty severely for US companies doing business in China. They've already sent the warning to European companies about going after the EV market there and how they'll respond. And it includes harassing companies, discouraging consumers in China from buying American, limiting the exports of critical materials. And I think that's the big one, because the world's not ready for China to shut them off from critical resources. I also believe this policy is not going to lower costs in the US. It'll transfer costs to the consumers, and I don't think it'll work. But if it's done for concessions rather than actual policy, that may be helpful. But I think that's an optimist's view of things and not grounded in the way the real world works. So I think we have to see how that plays out. I think free trade matters, and it matters greatly for the global system. This is per capita GDP by leading nations back in the 1980s. And you can see, even in the US, we were around 30,000 per capita. And this is where it was in 2019, significant growth around the world. Over 2.5 billion people came out of poverty because of globalization. We really have to think long and hard about how we trade globally and how we create a fair system. But free trade is going to matter, and I think the tariffs could work adversely. But I also think raising taxes on corporations will also work to slow growth. So I don't think either the policy of either candidates is going to get us where we're going to get to. But in the intermediate term, I think the setup is still strong for the US to continue to see the markets move up and continue to see the economy grow. I think it'll be a reflection of the fact that rates have come down, earnings are up, earnings continue to be strong for US companies, although they are quite uneven. That leads to stock selection being a key element. But I think the areas of national security, energy, technology, and healthcare are all the areas that are going to continue to attract capital in the public and private markets. So, Mark, with that, I'll stop and open it up for discussion and opposing views.
Opposing views.
I don't have an opposing view, but how do we balance onshoring, the trend towards onshoring with free markets? What's your view on that? How do we balance that?
I think it's interesting. I think between national security and whether it's supply chain security or actually defending your nation, you have to have enough resources to cover you internally. And every country's in the process of doing that. I think Europe's trying to figure it out on a country by country basis, which is, I think, wholly unproductive for them in terms of getting the scale opportunities they need. But I think that's really the play is you're going to have to balance both of those off. I think you need, I think you really ultimately are going to need, Giovanni, a balance between the US and China's behavior, setting a good leading behavior and bringing Europe with it to get the balance of regulation so that we're not over-regulating to create bad behaviors either. So I think it's good industrial policies, good national security policies, balanced with good regulation and an open-mindedness to work together, which I think we're pretty far away from. So I think it's not going to be, I think globalization will be under pressure. I think it'll be shifting towards alignments around allies and against adversaries, which I think is a pretty big shift. I don't think it slows the volume, but it changes the output. And I think it makes us less efficient and less productive.
Adam?
Thank you, Stephen. You answered my first question actually with that response. It was about Western sanctions and how that impacts trade GDP percentage. The other question I have is raising income taxes on corporations. Does that really slow down growth? Is my question. Where else are they going to make these investments?
Well, it slows down the capital available for growth if they don't pass it on to the consumer, which would then raise the cost to the consumer. So I think the taxes get passed through ultimately to the consumer. So I don't think raising taxes is going to help. And I think where we got the taxes to, I think the reality is corporate taxes are probably 2 or 3% lower than they should be for the OECD average. Trump could have brought them down to 25%, brought them down to 21. Going further is not going to be healthy either because it just puts greater strains on the system. But I do think that corporate taxes tend to get passed on. So I don't think that helps growth.
Thank you, Stephen.
Andy?
Stephen, I wanted to bring up blanket tariffs versus selective tariffs and the question of how you think, I agree with you about the globalization part and the tariff part, but to be realistic, there's never been free trade with China, India, and Brazil. Now the rest of the world, places in Eastern Europe have been huge beneficiaries, and we exported inflation for 2 decades to China. Now maybe we're doing it to Mexico. So Europe just put import tariffs on EVs, basically aimed at China up to 48%. I think Tesla's 7.8. We are just about to restrict exports of semiconductors, period. So there's always been this very selective thing. Europe's done it for years on farming imports and whatever. So in terms of if this is the way it's going to go rather than blanket tariffs, how much difference do you think, and it's definitely accelerating, I think it is. You can go to page 9, by the way, you had the change over time. And so let's assume there isn't just blanket tariffs, 60% on China but there's this continuing war of selective tariffs. How much do you think that is going to impede growth as you see the world today?
Well, it depends on the area. It's going to be on each area. What's the supply and demand dynamics and who has the resources for those areas, right? Because that's the other element. Can you get everything you need with the tariffs? Because I think what happens beyond tariffs is you get the cutoffs, you get cut off from access to things. We're trying to do that to China, trying to do that to us. So we raise tariffs, China starts cutting off access to rare earths. That's the game that's going to be played. That's where the growth starts to slow down too globally and makes everything more expensive. So you get some inflationary pressures and you get slower growth as a result of that. And then I think you're just raising the cost on the whole system. You're taxing the system eventually.
So you're saying there's not much difference is what I'm hearing.
Yeah, I think across the board it changes the whole game, but selectively you can manage around selective tariffs, but if the game escalates too much, then everything's tariffed, and then it's, what's the difference? Right?
That's
So it's degrees. I think Paul was up next.
Yep. Hey, Stephen. Hey,
Hey, Paul.
so in terms of tariffs, like I always kind of think of like, you talk about free trade and, we don't, I think we just mentioned it, we don't really have free trade in reference to tariffs across different countries. Like I always look at like the EU and the US and like you don't see too many Ford 150s like in Europe as work trucks, right? They don't, because they have a 10% tariff versus US, European vehicles into the US is around 2 to 3% tariff. So like, is it a good idea or do you think the politicians should focus on trying to equalize tariffs, for specific industries, especially like kind of countries that we're supposedly allied with, that, we have these, you can go back to the 1980s and you can see Donald Trump talking about it in 1985 and 86 and 87, like talking about how the US was getting affected by it, and Harris campaign is also talking about tariffs. Like, do you feel that there's a push or like from an economic reality? Do you think that it definitely could improve some way to have tariffs, or like try to equalize tariffs on some U.S. manufactured goods like autos, like to get more cars into Europe or other countries, just based on kind of like what we're seeing today? It's like, it's very difficult to sell cars just because it's not because it's just because of that 8% difference in price it's going to make a consumer just kind of change their behavior. Like, what do you view of like equalizing tariffs or trying to just kind of focus on tariffs in a way to kind of improve exports for some of these companies?
I think if the companies can't compete effectively on their own against what is a relatively level playing field, China doesn't provide that with the subsidies. I think China is providing subsidies to like 99% of the companies in China now. So that's part of what the offsets are for, is competitiveness. So I think you have to look at it as, what are we using tariffs for? Is it to level the playing field, or is it to unlevel the playing field, or for something else? And I think Trump's trying to use tariffs for an offset to his wanting to lower taxes. That's a tax policy as much as it is an economic policy for trade. So I think there's a lot of factors that are involved to your question, Paul. I think the idea of tariffs in and of itself, used selectively, is fine. I think when you weaponize it, I think it leads to other issues that create bad outcomes. And I think that's what we're going to find from this go around if they go to that degree. I don't know if that answers your question. Bill?
Thanks.
Hey, Bill.
Yeah. Fascinating stuff as usual. It seems that the question that popped into my mind is the transition of China from being an export-led, country and economic focus to more of a internal consumer-based economy. That's a trend, not a reality yet. I was just looking at some of the export-import data on U.S. Versus China trade. It actually hasn't changed a whole ton. So I think, to your point, the selective tariffs are probably going to be more significant than perhaps across the board. That makes sense as well.
Yeah, I think that's one of the really interesting things that's still going on today, is that I'm not sure the Chinese policies right now are designed to rebalance their economy or to continue down the path of being an export-driven, export-dominant nation. And that actually has big implications. If they were rebalancing it changes their dynamic considerably to less of a global threat and more of an opportunity. But right now, we're not seeing that. So I think that is an interesting element, Bill, of if China rebalances, then tariffs become less of an issue because they become a bigger market that people can participate in theoretically. But without that, you get China dumping on the global system and not being much more, and being a more closed off market for the rest of the world. That doesn't get them where they want to get to, I don't think. So I do think you're touching on an important element of how China grows from here. And I do think this idea of them stimulating to stabilize versus stimulating to grow the world economy is something we have to get our mind around here, that they're not going to do what they did in 2008 to drive global growth the way they did back then. They'll still drive global growth, but the lift won't be what we saw in the past. I think that's a very different setup for us.
Right, yeah, I agree with you totally there. I think they're a lot more worried about what's going on internally right now than their impact on global markets. Also, just to add a tidbit, going back to the employment data release, I saw some interesting commentary on the fact that a lot of that rise in number could be due to an unusually high seasonal adjustment. So stay tuned 2 weeks and see if there's a revision downward. We'll see. But that's
So the question was the July one due to a seasonally high adjustment too for weather? So, and we'll have more squishiness with the weather problems in the numbers over the next couple of months as well.
right.
There's a tragedy in the Southeast.
Absolutely. Didn't mean to derail the trailer point, but
No.
I thought people would need to know.
Michael.
Yeah, so you're talking about selective tariffs versus general tariffs. But and most of this is in terms of the US versus China, EU versus China. China has been relocating production or sending output through third countries. So what kind of strains does this put on the WTO, the system of trade and tariffs that we've had for quite some time?
I think as we've talked about, I believe that the governing institutions following World War II have all outlived their useful life and need to be updated to reflect the way the world is today, not the way it was back then. And the rules need to be leveled so that China is not viewed as a developing economy, as the number 2 economy with the benefits that come with an emerging economy in that area. But I do think it calls into question the structure and the mandates of all those and a rethink of what their policies are to make them more relevant for the future. I think would be true of the UN and WTO and other organizations like that came out of the World War II. So I don't think those institutions are reflective of the economic realities of the world today.
So do you see any risk of any of the major players pulling out of the WTO, for example?
Depends on the election. You could hear some threats from that, but generally, no. I think it's easy for those who want to abuse the systems to abuse them right now and undermine them, and it's hard for the ones who want them to work to get them to work right. But I don't know that the problems that countries are facing domestically are affording them the time to focus on that. So I think it's an area that the world needs to look at, though. This is just think we're 70 years past and how different the world is today than even 10 years ago or 20 years ago. So I don't think they're designed for today's world. Jonathan.
Thank you. We talked a lot about the tariffs. We talked a little bit about corporate tax rates, but there's a lot of other proposals out there coming from both Trump and Harris. What are the, one or two things aside from tax rate, the corporate tax rate and tariffs that stand out from each of those candidates that either you see as potentially beneficial or worrisome from each of the candidates? Like what stands out the most to you other than those two things?
What stands out the most to me is the total lack of any kind of situational awareness for how bad the fiscal situation is in the US. There's no efforts to rein in any of the runaway costs that we have here. It's all about pandering for votes. So I'm actually just shocked by the policies that are coming out. So the thing that strikes me the most is just what this means for debt and deficits going forward, and how do we ever get Social Security and Medicare under control. And it's not just here that you go around the country, go around the world, and the fiscal positions of governments is terrible and the needs are growing. And you just look at the rebuilds that are going to go on, which I think is going to be one of the great investment opportunities going forward, whether it's the rebuild in the Middle East, the rebuild in Europe, or the rebuild in the Southeast here. Massive spending going on in those areas. I just think the policies are not reflective of the number of the size and scale of the problems we have. And I think they need to triage differently instead of pandering to everyone. So I just think they're not grounded in the reality of what the problems are. So
that's a good point. And as you look out to, let's say, prognosticate a little bit, look out to the, let's say, midterms in the next administration. So let's say, 2 years out. Where do you think you're likely to see the 10-year note 2 years out? Stay where it is today. It seems like it's less likely to go down much, right?
I don't think the long
side to it.
Just regardless of who wins, I don't think the long end, if it comes down much from here, I think we're all going to be miserable, to be blunt. I just don't see, I don't think the problems that would get it down are not ones we want to deal with. I think the 10 years probably around, not too far away from where it should be. But I think the policies could be inflationary that could push it further up. I think we could see inflationary pressures reemerge because the policies that are being proposed in 2 years out will be into the new midterm, and whoever won will be trying to defend whatever they did in that time, because I think both will be problematic at that point. If either sweeps, I think in 2 years you'll be looking at another reversal of who's in power, because I think the policies of both, if they go ahead with their plans, would lead to bad economic outcomes.
Thank you.
You're welcome.
Stephanie.
Hey there. I just so we talked a lot about kind of what's potentially coming, but I'm curious if, from your perspective, there'll be any reversals or repeals. So selfishly, I sit in the healthcare sector. I'd like to see a little bit more reform on IRA, because I think it's already stifling innovation from what I see across the sector. But do you see any potentially changes on the reverse of it? So on the what exists today, and any of the kind of repeal in that regard to potentially help with stimulation of growth in any particular sector? Or I mean, I only particularly know healthcare very well, but I don't pretend to know the rest.
I think government is trying to. I think the outcome of the election will impact different industries very differently. You look at the fossil fuel industry versus the renewables is the easier one. I think regardless of who wins, I think the healthcare area will continue to do well, because I think it's the biggest beneficiary in the near term of the benefits of AI. I think the policies around of either candidate will really come down to the antitrust issues will be a big one on the table for the Democrats if Harris wins. And I think that goes towards, I think that's where the healthcare industry, price pressures, and the tech industry really get a lot of pressure with a Harris win. I think at a Trump win, I think the areas of the Affordable Care Act and part of the Inflation Reduction Act that go to the clean energy would be areas that a Trump administration would try and impact. It's not fully clear how much of that it can be reversed that quickly and cut off. But the other thing that's going on is the state and local government support for these programs and the backing that the private sector has towards this, I think will offset some of the changes that the government wants to do in them. So I think it's going to be mixed, and I don't think you can really know until you see who wins and do they sweep or not. I think from my seat, and this is personal, not an ARS position, although it may be the firm's position. I think we're hoping for a divided government because we're baffled by the pandering that they're doing for votes right now in policy.
Thanks, Stephen. I feel your sentiment.
Stephanie, can I ask you a quick question?
Yeah, sure.
How is the Inflation Reduction Act stifling innovation in healthcare? That baffles me.
So everybody wants their pound of flesh, right? If they're going to save 300 billion over this act, who's going to pay for it? The innovators are going to pay for it. And so part of the issue, like I could go on this for ages, part of the issue with the US healthcare system is the intermediaries. It's not the innovators, and it's not the patient population at the end, it's the intermediaries. So give you an example, McKesson makes about $350 billion a year. They make nothing, they do nothing, they're just an intermediary, and they make about maybe 10% off that, or less than, maybe like 3% off that. Just that's their profit margin. So for doing nothing and being a distributor, that's what they do. But guess who pays for that? The patient pays for that. So what happens on the Inflation Reduction Act is they pass on and reduce. There's a ton of different swim lanes. If it's 340B, if it's Part D of Medicare and Medicaid, and there's different swim lanes that it passes the cost back to the innovator. But I'll tell you this, I've been in several meetings with the chief medical officers of big large caps that have cut programs because they're not going to yield the return that it would need to pay for the clinical development to get that asset to market. So who ends up hurting from that is the potential patients in those swim lanes or in those therapeutic areas that could benefit from innovation, because they know that they're going to have a clawback from the US government. And so what's interesting is it's shifted conversation and programs. So a lot of the large caps are shifting towards immuno-oncology therapeutics. That's where the biggest, sort of margin play is from an economic standpoint. I mean, at the end of the day, it's a little bit different because you're not selling widgets. You're actually selling life-saving treatments to patients on the other end. So, but at the end of the day, the innovators are paying for a chunk of that. I wouldn't say all of it. And there's still a lot of gray in the IRA legislation that companies are trying to navigate, but I've seen it take anywhere from 1% to 3% off top line of these big large caps. So it's still an area they're trying to figure out and trying to manage within. But I personally, in my own soapbox stance, is there needs to be a call for regulation on the intermediaries. So it's just insurers, wholesalers. It's just the cost is getting passed on to the American people that can't afford it. Anyways, I digress. I could talk about this for ages.
What would the regulation look like, though?
Oh gosh, I don't know how long we have. There's a lot of different swim lanes that could particularly play within. But if you look at the single payer markets, like here in Europe, so I'm based here in London. The flip side is the focus on. There's no focus on preventative care. It's all, if you're ill, you go and you get treatment, and they pay for a certain level of care within each potential disease area, and that's what you get. So the capitalistic market that what US offers is choice and endless treatment options. But that comes at a cost because only the rich or upper middle class can technically afford it. So there needs to be a lot more regulation from probably a pricing perspective that, cut out the middle swim lanes and the middle intermediaries. There's a lot of supplier distribution agreements. There's a ton. And then the government programs are very broken. So you have programs like 340B where charitable organizations are making profit from it. I mean, there's a lot that's broken in there. So just doing a blanketed IRA bill to pass it on to the innovators. And again, I'm sweeping the sector. It's a bit frustrating because that there needs to be more government reform as well. So I don't know. I'm happy to talk about. There's a lot in here, but I don't want to talk about healthcare or kind of commandeer the conversation. But it is a big. It's a sector that's a necessity to life. So it's always going to be a growth sector. It'll always be something that people are willing to invest and try to promote innovation within. It's just how do we have better access and regulation? I think it's a bit broken personally.
Yeah, and the fascinating thing is that 16% of GDP in the US, double what it is for most developed nations. So we don't have a good structure at all in that system to be that inefficient. So you're onto something. Michael?
So, Stephen, in your previous comments, you said something I found interesting. That is, your preferred outcome is divided government. But there's multiple ways that government can be divided after the election. So what would be your ideal division between the House, the Senate, and the presidency?
Well, I think the reality is it'll be this. If it's divided, it'll be the Senate goes to the Republicans, Democrats get the House, and to me, to be blunt about it, personally, I'm so disgusted with both of their policies, or the lack of understanding of either one, that I think I just want to divide a government. I'm not sure which one, based on what we know right now, their policies, that I can make a decision on which one would be least bad. That's how I look at it. So.
Okay, thanks.
You're welcome. I'm not hedging. I truly don't. I wouldn't vote for either one of them, to be honest with you. Andrew?
Thanks, Stephen. In addressing the political landscape and being wary of the third rail with 361, but pertaining to health, and in fairness, I don't know if Harris has designated anybody to cover this, but RFK Jr. seems to be talking sense about cutting to the core of healthcare, and that is our food supply. And America falls woefully short on a relative basis globally to other countries. I just wanted to add that to the discussion that, whether you like Trump or hate Trump or like Harris or hate Harris, I'm looking at the people that they are surrounding themselves with, and pertaining to health, RFK Jr., and this is not an endorsement for either side. I just think that's as much a part of the healthcare debate as everything else.
Thank you.
Anyone else?
Hi all. I just wanted to add, there is a reason why I have Stephanie on my board of advisors. Anyway, good to see you all last week.
Oh, thanks, Mariana. I have to say, I'm not as well. I think, Stephen, you take the cake. So I know my one swim lane, but one day, Stephen, I will get to your level one day to know it all.
I think you're way ahead. So thank you all.
I feel like I need a Stephen GPT.
You got the correct, Stephen.
I think she's trying to replace you, Stephen.
Oh God.
I've
Not possible.
been done before.
I love that idea.
Stephen,
Stephen,
well, you made a comment about the 2-year, being lower and we would all be paying the price. Could you elaborate on that? Because as we just pointed out, long-term rates are already down and now we're just talking about the short end.
Actually, the question was on the 10-year, and I was saying the 10-year I think is where it should be.
I'm saying the same thing, but then you added to that.
Yeah.
If the 2-year was cut in half, for argument's sake, we'd all be sad. But
No, I said if the 10-year comes down a lot from here.
No,
if the 10-year comes down a lot from here, it would be a problem because I think that means we're starting into another deflationary spiral.
I misunderstood. You're right. It's a recession. You're right. I take it back. Sorry.
Yeah. I think the short end has to come down and has plenty of room to come down. I think mortgage rates have room to come down even if the 10-year doesn't move much because they're probably maybe a point above where they should be now already. So that could help. But I think if you look at the policies that are out there, you look at some of we've been fortunate globally that oil prices have been coming down with the frictions around the world. That could easily have run inflation up quite a bit if we saw a spike up to $80 or $90 on oil. And it doesn't look like anyone wants that right now. That could make a difference. So that's one thing to keep an eye on. But yeah, I think there's upward pressures on inflation that are right out in front of us between the policies that are being proposed by the candidates and just by the underlying pressures in the system. So something to keep an eye on. Chris Mayo. You're on mute, Chris.
Chris?
Sorry about that. I must have hit it accidentally. My bad.
I think we've exhausted a mark.
No, I've got some, and I apologize, everybody. I've got some sinus issues with the change of weather. But I thank you, Stephanie, for it. Reminded me, Bill, when someone asked a question about digital assets, and Bill gave a 10-minute lecture. But we need a health tech deep dive.
I was talking to Vishal about it because I'm happy to partner with whoever, because I think there's some interesting pockets coming out of where, so, again, for a longer topic, but given where large cap is sort of stifling at the moment, it's pushing a lot of innovation into this spin outs and startups. And so there's a lot of interesting pockets that are forming in different swim lanes within the healthcare sector that could be quite interesting for investment. And so it just depends on your risk appetite, because life sciences is a very different investment horizon versus anything else. So if it's something of interest, happy to help something together, because it's definitely a passion.
Something just came to me, Stephanie. I play on 3 different soccer teams in New Jersey, right?
Okay.
This is pharma territory.
Yeah.
So we've got the 30 and overs, the 40 and overs, and the 50 and overs. And the 50 and overs are in big pharma, or they've spun out of big pharma.
Yeah, sounds about right.
And they're doing M&A. They spin out because they're frustrated because they can't innovate. If they're a real innovator, they have to get out. But then they maintain all these friendships because they know all they have to do is go innovate, and they got a natural buyer.
Yep.
And then at a bar, they talk about it.
Yep.
And it is what it is.
Can I tell you the best story and this is for insider trading, by the way, was the most trafficked route is from Newark to London. So basically you have all your large caps and your mega caps that will go Newark into London for any of, and then London anywhere else. But that sort of 8-hour flight is probably the one most trafficked in life sciences. And there was an analyst from one of the banks that happened to sit behind two executives. I think they were at Pfizer or something, one of the big companies, and they were talking about quarterly projections. Stupidly shouldn't be talking about that in public, but here we are. So analysts learned something interesting, went back to his partner. They made a bit of cash, but then they started realizing that that was the route where people were talking about it. And so you notice that on the flight bookings with a lot of pharma executives, there were a lot of analysts, and then actually a few got nabbed by the SEC, and one went to jail. So interesting that you're very correct in the pharma.
Okay. Mark, for everybody else, all the mega caps are based in New Jersey, south of Newark Airport, just for context.
Yeah.
Okay.
And it's a shame, to your point, because the innovation potential is there. They're sitting on intellectual property, and it's just a real shame.
No, and to the point of the people that I did 10 years of research in industry, and they own all my IP, and that's why I left. So it's a very interesting they have the funds that can definitely, you can pursue any research, but the flip side is you don't own your IP. So it's quite common what you're talking about. And then if you have the relationships, it's very easy to build a valuation and get bought out down the road. But there's lots of swim lanes in this to discuss, and there's lots of
wait, Stephanie, you must be a swimmer. You've used the word swim lanes.
I know. It's a very consulting thing. I should stop doing that, actually, but
that's right. We'll have to talk about my 1 year of swimming and what swim lanes represent. But I overcame. I made me resilient. I'm not a good swimmer. Well, thank you, everyone. Sorry I wasn't as engaged this time. But we'll be back at it next week. And we'll do a health tech. If you want to come tomorrow, we'll talk about what to mobilize event-wise.